This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is see you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode dives into the evolution of infrastructure investing with the leading independent scaled specialist firm in infrastructure. We sat down in Stonepeak's Hudson Yards office with a pioneer in infrastructure investing, Mike Dorrell. Mike is the chairman, CEO, and co-founder of Stonepeak, building the foundations for the firm to achieve a rapid ascent to $73 billion in AUM from its founding in 2011. Mike brings deep expertise to the infrastructure asset class. He has over 20 years of experience investing in infrastructure, starting his career at Macquarie, where he ultimately had the title of Senior Managing Director. He then joined Blackstone, where he was a Senior Managing Director in private equity and co-head of the Infrastructure Investment Group, before striking out on his own to build one of the industry's largest infrastructure investing firms in Stonepeak. Mike and I had a fascinating and thought-provoking discussion about infrastructure investing and why it's becoming an increasingly important part of the private capital ecosystem. We covered the early days of infrastructure investing, how infrastructure investing has evolved, how Mike's experiences at Macquarie and Blackstone informed how he wanted to build Stonepeak, how institutional investors have approached infrastructure investing, and why individual investors should consider exposure to infrastructure assets, Stonepeak's DNA and what makes the firm different from other infrastructure investors, why being a scaled specialist is a competitive advantage, how Stonepeak was built from scratch to scale, how Stonepeak identified investing in data centers early on and well before the data center boom began, and why launch a wealth solutions business and how it's a reflection of the firm's DNA, culture, and values. Thanks, Mike, for coming on the show to share your wisdom, expertise, and passion for infrastructure investing.
In a collision of culture and finance.
We're going mainstream.
Mike, welcome to the Altco's Mainstream podcast.
Hey, Michael. Thanks for having me.
Well, no, thanks for having me in your office here. I think a testament to the firm that you've built since 2011, an incredible rise as a firm, and also an asset class that has grown a ton. A lot to talk about. First, I want to start with your background, though. You're an Aussie, so maybe it makes sense that you ended up in infrastructure. But tell us how you got to Stonepeak and what took you here.
Sure. So I did my college, or as we say, uni, in Sydney, Australia, on a beach, as it so happens, which was lovely. Went straight from college to Macquarie and was very, very fortunate there that Macquarie has a unbelievably entrepreneurial culture. And it just so happened that in the late 80s and early 90s, the Australian state governments started to get into real financial difficulty. And so as part of getting out of their financial woes, they started to sell off traditionally government-owned infrastructure assets. And so initially it was toll roads and airports. And so Macquarie, being as innovative as they are, thought, my goodness, like these are such unique assets. They're natural monopolies, they're essential, very high barriers to entry. It's really close to impossible to replicate Sydney Airport. You know, it's almost impossible to replicate important toll road that, you know, gets commuters from outside the city to the city. So very, very unique assets. And so Macquarie found a way to buy these assets and package them up for institutional investors. The financial characteristics of these assets are so well suited to folks who want to match their long-term liabilities with a long-term set of cash flows. So anyway, Macquarie found itself in this magic spot and took advantage of that. And I happened to be a young whippersnapper at the time, getting to witness and be involved in all of this. So that was the start of my journey.
What excited you most about infrastructure and what made you say, hey, I want to go do this?
Absolutely nothing excited me about infrastructure. When you're a 25-year-old, it kind of sounds, in fact, when you're a 50-year-old, it still sounds pretty boring if you're being, if you're being honest with yourself. But so I kind of lucked into it. So I was more excited about coming to New York than I was about getting involved in infrastructure. And so I put my hand up as a 26 or 27-year-old and said, hey, I want to go abroad. Because, you know, Australia's a long way away and it's an amazing place, of course, but it's a small country from a population standpoint. And you just want to get out and see the world. And Australians have a great sort of legacy of getting out to see the world. And so I had the opportunity to come and join this Macquarie startup office in New York. And all we did in New York was infrastructure. And so I was, you know, found myself in the infrastructure group with just a half dozen other folks. And we felt that the US, well, I should say Macquarie felt that the US was going to be a pretty tough market to crack because, again, at that time, this is back in 2001, really the far and away the most common infrastructure categories were airports and toll roads. And in the US, there really weren't private airports and there really weren't private toll roads. And the reason for that is that there's a really deep, strong financing market in the US that a lot of folks on Wall Street will be familiar with, called the municipal bond market. And that's a tax-advantaged structure whereby you don't have to pay any tax on the interest you receive. And so therefore, the issuer of a municipal bond can charge a lower interest rate. And so you have all these toll road authorities that look after a toll road and airport authorities that look after an airport, and they're able to fund themselves by issuing these municipal bonds. And so Macquarie looked around the world and felt, you know, we can tackle Europe because Europe looked a lot like Australia. We can go and tackle Canada because Canada looked a lot like Australia. But the US, as big as it is, that's going to be a tough market to crack just because of this municipal bond alternative. And you think about it, if you're the CEO and staff on, say, the New Jersey Turnpike Authority, and you've got, you know, a job for life and you're able to fund yourself with municipal debt, and Macquarie comes along from Australia and says, hey, you know, Mr. Toll Road, would you consider selling to us? You know, like just human nature is like, no way, okay? Like we're set up, we don't need the money, we can fund it through muni debt. So we thought the US market was going to be hard to crack. And because of that, Macquarie sent over all these young guys, you know, like I was, as I say, 26 or so, other than maybe one or two folks who are a bit older. Murray Bleach, who's the boss and a close friend of mine, was a bit older. We were all young. And so it was just this incredibly energized, vibrant situation. And what I really loved about the sector ultimately is not because I'm in love with toll roads or airports or utilities. It's the fact we're in this, we had this opportunity to grow a business from nothing and frankly create an investment class from nothing. That's what was so exciting about it.
How did you go about navigating the early days of the US infrastructure market structure that was harder to crack? What did you do to help build that market at Macquarie?
trying to do two things when you're in our job, in any private equity job. You're trying to raise money on the one hand, and you're trying to find things to invest in on the other hand. So on the raising money side, we did our best to go around and visit pension funds around the US to introduce them to infrastructure. But, you know, for the first bunch of years, no interest at all. No one had heard of the asset class. You know, private equity was well established, credit was well established, public equities were well established, etc. Real estate was well established, but infrastructure was unheard of in the US. And so naturally, you know, there's no one to meet with. You know, the private equity person at you know, CalPERS wants 25% returns. Infrastructure doesn't get to that level. The credit person wants credit, etc. So we had real difficulty garnering any interest whatsoever from the US pension fund community initially. And so a lot of the money in the early days came from the Aussie institutional and public markets. And then the Canadians got onto it very early as well. So Ontario Teachers was maybe the first non-Australian institution of size to really get interested in infrastructure. And they went from, I mean, they were real pioneers in the space. You know, Leo DeBeaver, who I've never met, but he's well known to Macquarie in the industry because he was the CIO of Ontario Teachers. And so he was a real pioneer in Canadian infrastructure, for example. But anyway, on the fundraising side, like, we had real difficulty getting that going in the US. So we were using money from elsewhere. On the asset origination side, our group, you know, naturally split into two. There was one group that would go out and pitch cities and states on selling toll roads and airports. I didn't get so involved in that. It's like a long, hard path to get that going. Once you get it going, so a really, you know, call it an early success in terms of generating deal flow on that side. Maybe the first deal of this type I can think of was Chicago sold its Chicago Skyway toll road. That was the first success I think anyone had in getting a city or state to think about selling, you know, an asset. But the problem is, if you manage to get a city to do that, and it takes a long time, you're then subject to a 6 or 9 month sale process, and you've got absolutely no advantage versus anyone else who decides to show up at that sale process. So that's why I personally didn't love spending my time doing that. But Macquarie had some success, particularly in Chicago with the toll road, and then there was some parking assets that were sold off. City of Chicago did sign an agreement to sell Midway Airport at one point, but the buyer pulled out because of the global financial crisis hit. But anyway, a little bit of success, but given how big the US is, like only a drop in the bucket of what could have been. On the other hand, what we discovered really through necessity is that the US is far and away the biggest market for privately held infrastructure. And we tend to break infrastructure up into three buckets. Energy assets, which is, you know, it's oil and gas pipelines. It is power assets, you know, gas-fired power, wind power, et cetera, but energy stuff. Transportation assets, so obviously a toll road or an airport would fall into that category, but there are so many privately owned transportation assets in the US. Ports are a good example. There's a lot of logistics assets that we fall into that category. We love logistics assets because if you have a big network, say, you know, one of the things we own is a big cold storage network. If you own a big network, there are enormous cost advantages to that in the way you can operate versus someone who's got a much smaller network. And so that's a very natural barrier to entry because you're the lowest cost provider by far with that big network. And big networks also provide the opportunity to put very high returning capital to work just by putting extra branches on that network. So we really do like the logistics side of the transport vertical. And then the final one is digital, you know, data centers, which are obviously, you know, very popular today, but also cell phone towers, fiber businesses, things of that nature. So they're the three categories. And what we pretty quickly worked out is that there's no market on the planet that has the breadth and depth of assets in any of those categories relative to the US. So that's the way we prosecuted that business in the early days at Macquarie. And frankly, that's the way the whole infrastructure industry has moved over time.
There's a lot to unpack in there, both on the investor side. I think there's a lot that both institutional investors who haven't done in infrastructure as much, and then certainly the wealth channel, what they can learn from the Australian supers and the Canadian pensions who've done infrastructure for quite some time. So I want to unpack that. I also want to unpack what changed, particularly in the US, on the asset side or the owner side of unlocking that market and making it more available and accessible to private infrastructure investors, so that people felt comfortable. We'll start there and then we'll get to the investor side, because I think that probably informs some of how investors think about it and also how they can think about the opportunity, because you don't just invest in equity, you also invest in credit, you also have real estate, you have decarbonization, they're all related to some extent, but you also have distinct strategies and areas of focus as a firm. So I'd love to start with what unlocked the market so that asset owners or municipalities, governments thought, okay, maybe we should consider taking private capital, or maybe these were totally private opportunities, and that changed the market in terms of how you think about infrastructure.
Yeah, I'll talk about the US experience. So on the government-owned asset side, I don't think that's ever unlocked in the US. I think that's a unbelievably gigantic opportunity that just sits out there that one day we all hope will get unlocked.
On that point, is that something that you think will change? I feel like we're seeing this trend of public to private. Governments have a lot of debt. There's this move towards private in every respect. We could say that's happening on the equity side with companies, right? There's less companies going public and more companies are staying private. Maybe that theme can also be transposed to the infrastructure side. Is that a trend that you just see continuing, in that infrastructure can help fill a gap for governments that they just can't fill on their own?
It is a big trend around the world, for sure. You mentioned, Michael, you've spent some time in Sydney, for instance, which is where I grew up. The road system there, the airport system, is unbelievably great. And every time I go back there, which is, these days once a year, there's a new toll road or a new feature of the airport. It is absolute A+ infrastructure. But you pay a toll, okay? To get from the airport to where I'm going. By the time I get there, I've paid a few bucks in tolls. So it's a trade-off. But, a lot of countries around the world have made the call to go forward with that trade-off. The US hasn't done that so much yet. So I would not say today there's a trend in the US towards privatizing these assets. In fact, I'd say there was a spurt of them in the early 2000s when Mayor Daley was in charge of Chicago. And then there's been a bit in Virginia, and Indiana privatized a toll road, but it kind of stopped. And I always think that with the debt situation that we're in here in the US at the federal level and at the state levels, I think there's always the strong possibility that we will start to see some privatizations in the US, but I wouldn't bank my business model on it, because we've been saying that for the whole 24 years I've been here, and it hasn't really gotten going.
Do you think that there's going to be a bifurcation of the haves and have-nots? So privately funded infrastructure assets, the trade-off, like you said, with the Sydney toll road example, you pay a toll, but it's better quality. Do you think that's where we're headed? Is this kind of haves and have-nots? I mean, JFK may be one example where for some time JFK was not necessarily the best infrastructure asset in terms of the consumers going in and seeing the airport. But now I think it has taken on some private investment. And you look at the terminals, it looks a lot nicer, a lot of new restaurants, things like that. Is this going to be a matter of assets that are privately owned, invested in by infrastructure investors? They might end up being better, and people may see that experience versus ones that are
Look,
not as good?
I think that you don't need an expert opinion on this. I think anyone who's traveled around the world, if you go through maybe I'm better informed at which ones are privately owned and which ones aren't, just because I'm in the industry, but a lot of the airports in Europe are owned by private investors, and they are pristine. And the airports in the US, and God bless the US, I love the US, but the airports are shit, generally speaking. And you're right, JFK's improved a lot because they've got some private investment there in the terminals, and LaGuardia has improved a lot. Even Newark has improved quite a bit because they've got a private operator of their retail concessions. But it is, I mean, if you ever wanted a very stark black and white example that the private sector does it better in terms of operating a business than the government sector, I think airports are maybe as good as an example as you'd ever want to see.
I think that's such an important point, because if you think about infrastructure, I think one of the things that's so fascinating about infrastructure and infrastructure investing is that everyday consumers, they may not think about assets that are infrastructure assets, but they're walking through them every day. They're walking through an airport, they're driving on a toll road, they're going over a bridge. How do you think about connecting the investment side of what you do to the real world side of this really impacts people's lives? I think Stonepeak it provides access to over 5 million people in terms of broadband services with some of the assets you have on the telecom side. Like, that's real impact, and that's impacting people's lives on a day-to-day basis.
I'll give you some stats that even surprise me. So in relation to Stonepeak, so 23% of all internet traffic in the US goes through our data centers, for example. 30% of all refrigerated food goes through our cold storage facilities. 25% of all containerized port traffic is in our containers, and 10% of all crude oil in the US goes through our pipes. It is, so to your point, these are massively important assets on a US overall economic viewpoint. And so you need to be super sensitive to how important these assets are. So public engagement is very important, because, as you say, the public almost takes it, this is how it should be. You take it for granted. You're not even aware. It's just there. But the minute it's gone, it creates all sorts of commotion. Like if the lights go out, I was in the US on August 13, 2003, I want to say. I might have the year wrong, but I got the date right because it was the day before my birthday. When we had the blackout now you just take it for granted that the lights will go on. You take it for granted. And we had that blackout, and sad, I was working, we were buying a transmission grid that night. So I ended up working by torchlight over at Simpson Thatcher on 3rd Avenue there to 2 a.m. That morning. Unfortunately, and it was a great. Everyone who wasn't working had a great night, because it was a bit of a. I don't know,
the entire city was all blacked out. I think Goldman Building was the only one that had lights. There was this picture of the.
Really?
Yeah, they had the generators. I think they had some sort of generators that kept it. Yeah.
Oh, the poor analysts! They probably thought they'd get the night off, and
they didn't.
And they didn't. Anyway, you take it for granted, and so you can't. And then people are up in arms, and people lose jobs. Like politicians get kicked out of office when the infrastructure goes wrong. So you've got to get it right. So there's a huge responsibility to operating and owning these assets. There's a lot of trust that all the stakeholders are putting in you. You've got to have great engagement with regulators, great engagement with government, great engagement with the community. You need to be very careful and responsible with how you charge fees on these assets. There's a great example from back in the late 90s or early 2000s where, and a lot of my examples are Macquarie, because they dominate certainly back in the day, they dominated the space, and are still very, very big players in it. But one of the, sort of poor fellas at Macquarie had made a comment to the press in the UK about a toll road. And they said, how do how do you set the tolls? And he said something like, he's trying to be funny, but he said something like, we want to make sure commuters are hurting. If they're not hurting, we're not charging enough. Of course, that made the front page of the paper. That poor chap lost his job. Like, you know, that's a good example of the sort of things that can very easily go wrong as a manager of these assets if you're not careful about it.
From that point, how do you balance that maybe healthy tension of providing, they're privately owned, but providing public goods in some cases, and then generating returns for your investors, which I should mention, if pensions or institutional investors are investors, to some extent, that could be real money. So people at the end of the day may be investing and owning some of these assets, obviously through a pension plan, as an example. But how do you balance that element of infrastructure investing? Because you as a firm have to generate returns for investors. The businesses have to make money. And you also have to provide services and deliver the right experience for people so that they can live their lives.
In a lot of cases, it's regulated. So, you know, you own an electric utility, for example, or a toll road, for example. In most cases, the regulator will tell you what you can charge because, you know, if you own the local electric utility and if you could charge whatever you wanted to charge, you know, there's almost no limit. So those assets are regulated in quite a clever way, regulated to give you a pretty certain return. And then for other assets that are less regulated, it's just using good judgment. You know, it's having a long-term view on value, I think, is maybe the financial way to think about it. You could maybe jack up your profits in the short term, but eventually if you do that, you'll create the sort of commotion and noise that you don't want to create. You said it really well, Michael. You want to be in the background. You don't want people to notice you. You want to be in the background, and maybe your toll goes up with inflation each year. And maybe that's a little bit annoying to folks, but they accept it. You know, prices go up over time. And if you're not going out of whack with how their income is going up, people will live with that. If all of a sudden I'll give you a fantastic example from the US. So when Chicago sold its parking meter business, and this is not the fault of the buyer, but what Chicago did is in the concession, so the document that governs what you can and can't do as the owner of, or the lessor, or whatever the right word is, the concession owner of the parking meters, there's a concession document. And it tells you what you can charge, in this case, for each parking meter. And I'll get the numbers a little bit wrong, but you know, if the per hourly charge in Chicago the day before the sale was $1, then under the concession agreement, they agreed you could put up prices to $3 on the first day. And so, you know, the sale got a lot of press and City of Chicago got a nice price for that asset. But the very next day, the price of parking went up from, again, I'm making these numbers up a bit, but from $1 to $3. It might have even been more stark than that. It may have even been like a 5x. Folks went around with chainsaws and lopped the tops off the parking meters, and there was all sorts of terrible press around it. And of course, the people who get the blame, the folks who bought the concession. And that example, that really put an end to the privatisation trend in Chicago. Chicago had been far and away the most active in terms of doing this sort of thing, but that's an example, I think, of a maybe not the best managed process, because clearly if you put, people are going to be upset, you know, like, because they're not getting the direct benefit of the purchase price that was paid, but they're certainly being the direct payer of the fact that fees have gone up. So you just got to be, I mean, again, these are common sense things, but you've got to be careful about those
I think that's
issues.
an important point, though, because when you think about infrastructure investing, there's so many different components to it, maybe even more so than other strategies within private markets. What skill sets do you think you need as an infrastructure investor that may differ from some of the other categories of private markets?
I think it's a lot of things we mentioned. You know, government engagement is really important. Public stakeholder engagement is really important. You know, clearly we know our asset class deeply. Just as a, you know, expert in tech investing will know tech a lot better than I do. You know, I'll know how an electric utility financially functions a lot better than someone not in the industry. So there's a deep industry knowledge there. But I think probably the you know, what groups or divisions might we have that an investor in another asset class may not have? I think a lot of it's to do with that stakeholder engagement.
I think that brings up an interesting point, maybe not in the same context, but I think it's related, which is the wealth channel in particular. The individual investor has not historically had much access to private markets. They have not, as a result, probably had a lot of access to infrastructure investment. And maybe that's a category they should have investment, and particularly if they're using a lot of many people are probably using the internet services that you're providing. They just may not know that. Same with if maybe the food that's transported or the crude oil that's going through your pipes. I think that it's so interesting when you think about people having access to investments that they may actually use at some point. So how do you think about the evolution of the asset class as it pertains to the types of investors who can now have access, and why should individuals have access to infrastructure?
I might start with, the institutional market and get to the wealth channel market, because if you look at Australia and Canada, where this asset class started, and the proof is in the pudding a little bit, like if people tasted it and want more of it. So, the average allocation of an Australian and a Canadian pension fund or sovereign wealth fund to infrastructure is up above 10% at the moment. In many cases, it's a higher allocation to infrastructure than to private equity. So that gives you a little bit of feel for their experience. Infrastructure has these characteristics that are just so sought after: high barriers to entry, essential service, predictable cash flows, long duration cash flows, good inflation linkage. And I often like to cite the example that if you look at Buffett's portfolio, his two biggest holdings are infrastructure assets. I think his biggest holding is the BNSF Railroad, and his second biggest holding is his utility company. I think he calls it Berkshire Energy. He owns mostly electric utilities all around the US. And what he looks for in his assets, and he's very open about this, he wants a big economic moat around his businesses. And so Coca-Cola, through its brand, provides a big economic moat. Apple iPhones, through, I guess its brand or its superior tech, but I think more so its brand, provides a huge economic moat. And so infrastructure, not through branding, but through its own essentiality and its natural monopoly type characteristics, they have huge economic moats around these businesses. And I think because of that, these pension funds have just had good experiences with them. There's a predictability and a reliability to the cash flows that is higher than I'd call a typically competitive business. Now, because of that, you've got to pay higher price for them. There's a trade-off, like there's nothing free in life. And so we're not getting the 20-25% returns that private equity is seeking, but there's something about an asset that maybe delivers a 13% return, but delivers it year in, year out for a long, long, long time. And, back to Buffett, one of his most famous investments would be his Coca-Cola investment. And he put something like $1.3 billion into Coca-Cola back in 89 or 90 or something like that. And between, $10 billion worth of dividends and the share price today, which is $25 billion worth of share price value. So he's returned $35 billion on that initial, $1.3 billion investment. Sounds amazing. It is amazing. But his actual annualized return on that is about 13%. It's just gone over a long, 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 long time. And so I think that the institutional market likes the fact that they can have this reliable returning asset class that will go for a long, long, long time. And what you worry about, the most similar thing I can think of is perhaps a long-term bond. But the issue with a long-term bond is that, a 30-year bond, particularly the interest rates that we've been at, historically, the last decade, you worry a lot about inflation because, for obvious reasons, inflation is going to erode away the real value of your long-term bond. So the fact that infrastructure is often very well correlated or passes through inflation, you actually get this long-term compounding, but you're doing that long-term compounding in real terms. You're protecting yourself against the impacts of inflation. That's a pretty unique set of characteristics that, in their, 3-decade now experience with the asset class, has just really enticed the interest of...
Brings up an interesting question when it comes to asset allocation then. There's some infrastructure that's like private equity, or you're owning and operating these assets. Infrastructure equity, there's infrastructure credit. Where should investors put infrastructure in their portfolio? And where should they take capital from? Should it come from private equity? Should it come from fixed income? How do investors think about infrastructure and where it fits in given the characteristics that you just mentioned?
I think it fits very nicely between credit and private equity. I think that infrastructure has, as I mentioned just then, a lot of long-term bond characteristics, particularly at the lower risk end of infrastructure. So we divide infrastructure up into, there's a risk continuum, I guess, with any asset class. And at the low risk end, you may have a utility or a mature toll road or a long-term contracted power plant. And with those sort of assets, you can with a decent degree of confidence, you can write out the cash flows for the next 20 or 30 years. You might not be exact the way you could be with a bond, but you'll be pretty close. So that has a lot of long-term bond characteristics, and I think of it a lot like a long-term bond, ideally with some inflation linkage. At the other end of that spectrum, you may have say a data center business. And a data center business, there'll be more variability in terms of the future cash flows because it'll depend a lot on how many new data centers that you build, and also depend on, I actually should step back a little bit. With a data center, these days you'll get a 15-year, you build a data center and you'll get a 15-year contract with Microsoft or Google or Amazon. And so you can be very confident that you'll get the cash flows from that 15-year contract because those guys are great credits. And so you've got very good visibility for 15 years for that data center. But you're not so sure what happens at the end of 15 years, and you're not so sure how many more data centers are built. So there's a greater spectrum. Now, I would say that at that riskier private equity end, the difference between infrastructure and private equity is that I at least can underwrite quite reliably my downside on an infrastructure asset. So I can use those 15-year contracts in the data center example to know pretty much what my worst case will be. And I would say most infrastructure investors try and price their worst case to return their capital. So if I'm looking at a spectrum of outcomes when I'm doing my analysis for call it like a riskier infrastructure bet, my base case might be I'm getting a 13 or 14 or 15% return. My upside case might be 20%, and my downside case might be I get my money back and a little bit more. Whereas if a private equity investor is doing a private equity bet in the tech industry or in the chemicals industry or whatever it is, often their base case will be high. In fact, it inevitably will be high. It'll be a 20 or 25% return. Their upside case might be 40, 50% return. Their downside case may be, I lost, 2/3 of my money. It's a much broader spectrum. So I think infrastructure sits quite neatly between credit and private equity. And as I mentioned, Aussies and Canadians are at about 10%. US institutions, they're increasing rapidly. I would say today they're in the 3 to 5% allocation, but it's increasing over time. And so I think that if a wealth channel investor is just taking their cues from what the institutional market has done over time, I think putting 5 to 10 to 15% of your portfolio into infrastructure is a very sensible thing to do. And you probably just prorate that from your other asset classes, I would imagine.
Well, it sounds like as well, if you take the Buffett example as you did, there's real patience required. But if you are patient, and this works well with insurance companies, this works well with pensions who think about things, and sovereigns think about things over a very long time horizon. If individual investors are thinking about that as well, then infrastructure seems like a great place to put
patience, but also peace of mind. I read a lot of Buffett stuff, so I apologize if I'm using a few of his examples. But one thing Buffett will say that really resonates with me is he wants to invest in things where if he had to go away for 10 years and couldn't check on it and then would come back, he wants to invest in things where he would feel okay about that. And I think that's why he's so heavily exposed to infrastructure, because of that.
On that point, though, from your perspective, what's the biggest risk that you're generally underwriting in infrastructure?
It's so asset specific, so I'll give you just an example or two. Say we go out and buy an electric utility asset, then the biggest risk with that is, what is the regulator going to allow me to charge my customers? So we do a lot of work around understanding the regulator, look at what they've done historically. Now, it's not just ad hoc. Regulators have a lot of what they call rate cases, which are like judgments in a court context, but very detailed rate cases as to the math and the formulas, et cetera, that they've used to come up with what a utility can charge. But we'll do a lot of work around that, and we'll go and meet with the regulator, and then, so that's the biggest risk for, say, an electric utility. Take the other extreme, and which is maybe, say, the data center business. If we're looking at data centers, then what I might call operational questions we'll ask about: how many more data centers do we think we can build? What do we think will happen at the end of that 15-year contract? Do we think AI is going to continue to be a thing and therefore drive more data centers? How much access to power do we think we can get, and in what timeframes do we think we can get it?
I think there's two really interesting themes to unpack there around your point about data centers. So one is, I think you have a pretty interesting perspective on data centers and the risk. And you've talked about this in the context of ROA and return on assets, and how you think about what actually is a good investment in the data center space. Because to your point, maybe there's too many data centers. Which data centers are actually going to make money? I'd love to unpack that a little bit. I think you've talked about this before. And there's some, I think, nuances to that. Like, everybody thinks, okay, there's going to be a lot of data centers that are going to be required to power the AI infrastructure transition. But it feels like the devil's in the detail as to which firms may win and why, and which assets are actually good investments in the data center space and which are not.
So there's a very, very strong tailwind behind data centers today. So it may be the case that most data centers do fantastic, to be quite clear. But I'll tell you the way I think about it, for better or for worse. For us, it always comes back to, will we get our capital back in a downside case? And when we think about that downside case, we take away any thoughts of exiting. Just, if we clip coupons, are we going to get our money back? And so when I think about a data center example, I literally look at what it cost me what I invested to get that data center, whether I built it or bought it from someone else, how much capital do I have exposed? And then I look at, what am I going to get back from the contracts that we have with the customers? What do I think, in a pretty nasty case, those contract renewals are going to look like? And when I present value all that back, am I getting, well, I'm not really present valuing anything back. I'm just adding it up to see if I get my money back. And so when we attack the space, what we end up finding is that if you buy someone else's data center platform, just because it's such sought after space, you're paying a very big multiple of build cost. It costs, not to get too technical, but I think this math is simple enough. It costs you about 10 times your earnings to build a new data center. So it's said differently, if it costs me $100 million to build a data center and I have a 15-year contract with Amazon, I'm going to get something like $10 million in the first year of free cash flow. So, 10-to-1 ratio. Whereas to go and buy someone's existing platform, maybe I've got to pay 25 or 30 times cash flows. So there's a very big economic difference to building it versus buying an existing platform. And so inevitably, if you buy an existing platform for 30 times, you're never ever going to be able to do that math I described of adding up the cash flows from a contract and get your money back. You're going to have to be confident that you'll get good contract renewals over time. And you're also going to have to be confident that you can build a lot of new data centers at much better returns to also help you get your capital back. And they're both probably pretty good bets. I mean, they've been pretty good bets the last number of years, particularly because of AI. And it's been helped a lot because a very important feature of a business is the pricing power of a business. Your ability to pass through inflation or put pricing up, or because the best way to increase your earnings is to put the price up. I mean, because everything drops to the bottom line by definition. You don't have to put any capital to work to put your price up. You have to incur any more OPEX to put your price up. Just put the price up and you get more earnings. And so in the data center space, and I'm talking about primarily about hyperscalers and the folks who do cloud and do AI, historically, you didn't have great pricing power as a data center owner. And the reason for that is that data centers are essentially very large fridges, and these warehouses with great cooling. And my data center looks like your data center, looks like someone else's data center. When it comes to negotiating a new contract with a customer, you're negotiating with Apple, with Microsoft or Amazon. They're powerful companies, probably the most powerful in the world. And you've got a warehouse that's air conditioned, that looks like this person's air conditioned warehouse, that looks like that person's air conditioned warehouse. Like, you don't have to be a genius to work out that the person in the better negotiating position is the customer. And so pricing for contracts was not great for the data center owner for a long time. But then what happened is, with the advent of AI, so many data centers needed to be built, and it's still being built, that in many places we ran out of power. So now all of a sudden that flips the dynamic, because I'm no longer just a warehouse, like anyone else's warehouse. I've got access to power, and no one can get access to power anymore. And therefore I've actually got like a golden ticket. And so all of a sudden my negotiating standpoint with these other folks with the customers who absolutely need data centers because they're making such huge returns on their cloud businesses and their AI. They're making a lot of money in their cloud businesses that's also housing AI. They need data centers. And so it's flipped the negotiating dynamic. And so the rents, the returns for hyperscaler data centers have gone up enormously the last 2 years or so because of AI. So there's also, when I'm peeling all this, your question back, there's also a question as to, but how long are these excess rents going to be earned in the data center space? So because of all that, there's just some more, like, it is a phenomenal space where people have made phenomenal amounts of money in the data center industry. But I think that there are, to bring it back to how do we value things, like we try and write down the cash flows and present value them. And it's just more difficult to write out the longer term cash flows given all those dynamics. And therefore, maybe it's worth discounting the non-contracted stuff a bit more highly than you might in a more normalized world. Cut a long story short, I'm a big fan of building new data centers with long-term contracts so that you know what your worst case outcome is.
I think that whole example really brings up an interesting point in infrastructure investing. There are these mega trends that are happening so fast, and they're changing the world, AI being one example, and things are rapidly shifting in terms of the pricing because of the need for energy, et cetera. But yet you're making very long-term bets. You're hoping that you have long-term contracted cash flows. You almost have to think fast and slow at the same time. in a sense. How do you balance that? Because I think that example illuminates so much of that, right? There's some trends that happen and may change over the period of a few years, 5 years, 10 years, 15 years, but you may be underwriting or owning infrastructure assets for 15, 20 years. How do you balance those two things?
It's very asset specific, and it's just judgment calls based on a lot of experience doing it. And to be quite clear, like, we get things wrong all the time, but what you want to make sure is that the things you get wrong, affect your return. Make it a 10 instead of a 15, or make it a 20 instead of a 15. They don't make it a negative something. And so you're trying to anchor your basic return to things that are very, very highly likely. And you're willing to take more of a judgment call or a bet on things that affect your upsides, or, affect the deal 200 or 300 basis points in one direction or another.
The other aspect of what you just talked about with data centers is, it seems like there's a lot of nuance in making sure you're investing in the right assets. You've invested in data center assets at Stonepeak. What do you look for in data center assets that you'd want to own, and how do you create an edge? Like you said earlier, the Amazons, Oracles, Googles of the world, they had the pricing power for a long time. How do you create an edge so that your data center is different than, although I don't own any data centers, my data center, in that regard, when you think about the types of assets that you build, own, and then operate?
I think there's only really two ways to do it. You've either got to own an asset that truly has a moat around it, and if you don't have that, you got to have a long-term contract. They're the only two ways to do it. And so in the data center space, the assets that we went into the most heavily, in fact, the only data center assets we really went into initially were what are called the connectivity data center businesses. And what these are, there's typically one per city in the US, and they're typically the old telephone exchange. And over time, as telecoms deregulated and then fiber optic cables started getting built and networks started getting built, everyone wanted to come and connect to that telephony exchange, because that's where all the distribution points sort of went out to the consumers. And so fast forward to today, you think about how you access something on your phone. So if you're looking at YouTube on your telephone, what's happening is, say you got a Verizon phone, then there's a Verizon tower somewhere around here, or antenna somewhere that's zooming it to your phone. And behind that there's a cable from the Verizon tower that goes to a connectivity data center. And from that connectivity data center, there's a cable that goes to a Google data center that has all the YouTube servers in it. So what's happening is you're accessing those servers through a Verizon cable to a connectivity data center, then to Google's data center. And then if you flip over, you decide you want to watch Netflix, well, it's still going through Verizon's connection to that connectivity data center, but then instead of going to Google, it's going to Netflix's data center. So in other words, all these things that you access, particularly that have some latency importance to them, say video, for instance, the way that works physically is that there's one data center to which all these other data centers connect, and then the distributors of that content, the Verizons or your home cable provider or whatnot, they also connect to that same data center. So everyone can connect physically in that same data center. So there's a network effect. And so anytime someone builds a new network, so say, ChatGPT didn't exist, in terms of us using it 3 years ago, but it does today. So ChatGPT says I need to build a data center or house servers somewhere near New York, because I've got all these customers in New York that want to use ChatGPT. So ChatGPT sets up a bunch of servers somewhere around here. They build a fiber optic network that connects to the connectivity data center, because that's how they get to consumers. So everyone wants to connect to the same data center. That has enormous barriers to entry. If you go to the GAAP accounts of a connectivity data center and just calculate the return on capital, return on capital is just literally what it cost you to build versus your earnings. You're getting high teens unlevered returns on capital for a connectivity data center. And your pricing power is very, very strong. Not infinite, but you earn your return by putting your price up at those data centers. That's an example of true high barrier to entry, big moat around a business.
I think that example brings up something interesting if we zoom out and think about infrastructure as an asset class, more capital going into this space. There's obviously, it's I think, the asset class of all the private markets asset classes where the top 10 firms actually raise the largest concentration of dollars, so scale really matters. What I'm getting at with that point is, I imagine there's only a select set of assets that have real moats and barriers to entry. How do you think about navigating that aspect of infrastructure as an asset class when many firms, there's not many firms who have the size and scale to do it, but many firms who do have that scale are probably going after similar assets. How do you think about that aspect of infrastructure as an asset class? Or are deals so big and there's such rarefied air of the firms who can actually compete for assets that actually puts less pressure on than mid-market private equity, let's say?
It's probably the hardest aspect of what we do, is finding these assets at prices that we like, because it's never hard to sell someone on the sort of assets that we buy. It's got every characteristic that you could want in a business to own. And so the toughest thing is finding these businesses at fair prices. And it is still a nascent asset class in the US. It's, private equity has been around since, I think KKR might have even started in the 70s, so it's a 50-year-old or so asset class. Infrastructure in the US is, Macquarie was here in the early 2000s, but really it only had other entrants in like 2006, 2007. So it's not quite 20 years old, I would say, really, in the US. So it's a lot younger than private equity, and so it's still nascent in that sense. So it doesn't have the same degree of players. So that's good. But there's enough players out there that there's certainly competition for assets. And so there's a few ways you can go about trying to get an edge there. I think, it really boils down to either finding a seller of an asset who has some degree of pressure on them to transact. Like, ideally, it's a balance sheet pressure or a liquidity pressure, but that doesn't happen in most markets. You need a tougher market for that. Perhaps they want the capital in a hurry because they've got something they want to go and buy. So there's a timing issue there. Maybe the market is putting pressure on them to dispose of something because it's considered non-core, and there's a little bit of, whenever the market is putting pressure on you, there's a timing pressure there. Maybe it's a joint venture transaction where you've got to negotiate some sort of bespoke arrangement, and that doesn't really lend itself to an auction process. So there's all those sort of categories. And then finally, it's going and identifying assets that have all these characteristics that maybe haven't been sought out previously. Like data centers is a fantastic example. 10 years ago, data centers weren't considered infrastructure whatsoever. Now it's probably the most common infrastructure investment. Cold storage. I mentioned earlier, we supply something like 30% of the food products that need refrigeration go through our cold storage facilities. Cold storage wouldn't have been considered to be an infrastructure category 10 years ago. Now it's really sought after by infrastructure players. So there's a real opportunity to find these assets that maybe haven't been appreciated yet. But if you identify them, you can get them at, interesting returns. And then when they become appreciated by the market, not only do you get your sort of cash on cash returns, but price gets bid up and you get the capital appreciation as well. So there may be the ways we go about trying to get the best pricing we can.
I think what's interesting about the explanation of the evolution of infrastructure as an asset class, Stonepeak is emblematic of that as well. You mentioned kind of in the US, 2006, 2007 was when infrastructure started kind of becoming more of an asset class in the US. Stonepeak started in 2011. You've since grown the firm tremendously, 14 years. I'd love to talk about Stonepeak as a firm and how you're a founder, you're an entrepreneur, you built this business. How did you go about doing that in the early days? Why decide to start a firm as well? I think we talked a lot about how scale really matters. You started a firm from scratch, and in infrastructure, that feels like a very hard thing to do.
Well, I think it's always hard starting a firm, and it was very hard, but there was a lot of luck involved also. I happened to have found myself in this infrastructure asset class, again, not because I had some genius foresight to what might happen, but I wanted to be in New York, and that's all we did. So I became quite expert in it. And so I got to the US in 2001. In 2006, 2007, virtually every major Wall Street firm came to realize how interesting this asset class was and started a new fund. So Goldman started a fund, Credit Suisse got together with GE and started a fund, Morgan Stanley, UBS, and others. And almost overnight, every one of these firms were able to raise big funds. I think the smallest may have been $3 billion and the biggest may have been $5 billion, but they all sat within that $3 to $5 billion range. And because there was no pre-existing infrastructure asset class, the folks in each of these funds were utility bankers or power bankers or transportation bankers or whatnot. And so it was a moment in time where someone could be entrepreneurial and could go out and raise a big fund. And so I was still pretty young at the time. I must have been 32 or so around that era. But it was pretty obvious that I found myself in this very lucky situation of being expert in something that was becoming increasingly sought after, and you could be entrepreneurial. So that's what got me to do it. You know, it was. I think we all on Wall Street and elsewhere have ambitions to be entrepreneurial, and that just happened to be a moment in time where I kind of either I was going to jump or I'd never be entrepreneurial, and so I jumped.
What did you think in the early days would make you and Stonepeak differentiated as a firm?
That's kind of easy because, again, I've been doing it for quite a while by that point. And not only had I personally been doing it for quite a while at that point, but I'd been at an institution that had been doing it for a long, long time. And so when you're in an institution who's the expert at it, you get to absorb a lot of that as well. So I had like a really good education in what the asset class was in the US. And if you go back and were ever to read all of the, what we call PPMs, private placement memos, which are the sale documents for a new fund, if you read all the PPMs from all the firms I just mentioned back at that time, they naturally talked about airports and toll roads, because if you looked at the history of the asset class, that's what the asset class had been. The people in those firms are very smart, and they realized quite quickly, hang on, it's not airports and toll roads, it's other things, and they've all done very, very, very well. So it's no criticism whatsoever, but I just happened to be in a situation where I'd been doing it for quite some time. So it was quite easy to differentiate yourself, because someone on the other side of the table can tell when you're talking about something you know very well versus you're maybe less deep in it. And people catch up very quickly, and there's nothing special about me or anything I was doing other than the fact I've just been doing it a long time. So I felt quite confident in the way we could pitch our offering. Went from there.
It was still early days for many even U.S. institutions. You mentioned 3 to 5% allocation for even many of the U.S. institutional LPs. Obviously, Australians and Canadians and other sovereigns are a little further along. Early days, where did you think about going to for capital? Because it was still relatively early for many, even institutions, to start thinking about infrastructure.
It had got going by that point. So in about 2005 or so, Macquarie launched its first US fund. And around about that same time, another group, Alinda, also launched their fund. They were the first two funds in the US targeted at infrastructure. And Alinda raised I think 3 billion maybe for its first fund, and then within 18 months or so went and raised a $5 billion second fund. So it was like in the space of 2 years or 3 years, they raised $8 billion altogether. I mean, these are astronomical amounts of money. And at that time, if you were to go and, I've said this to others, if you were a very well-known private equity person and went and started your own firm, that would be very difficult to do. And you'd never raise $8 billion in 3 years. It just wouldn't happen. I think Macquarie had spent enough time educating the US by that point that there were US institutions starting to do it. And so by the time all the Wall Street firms saw this and launched in 06 and 07, between all of that, it got the US firms taking the asset class very seriously. So by the time I did it, I had a detour via Blackstone from late 08 to early 2011. And myself and Trent, who was my co-founder, tried to do this at Blackstone and had the most wonderful experience there, but it corresponded literally head on with the global financial crisis. And so we got to do a trial run there. Blackstone has the greatest network of pension fund contacts and sovereign wealth fund contacts that anyone could have. And so we got to go and meet hundreds, literally hundreds of institutional investors during the 2 and a bit years I was at Blackstone. Also got an unbelievably deep experience in how Blackstone goes about investing, which was a wonderful experience as well. And then at the end of that, we couldn't raise a dime. Like we could get meetings, but we couldn't raise a dime.
So your time at Blackstone, what would you say you learned the most about investing from the time that you were at Blackstone?
They're got to be one of the best in the business, maybe the best in the business at investing. And they had such a strong bias against doing an investment. They put a huge onus on the person proposing the investment to prove out their investment case. And the way they would approach it is they'd want to see that you could identify the 2 or 3 things that were really the foundations of the investment bet, and then that you had lots and lots of data to support your thesis around those, key elements of the bet. And you needed to own your due diligence. You certainly lean on experts and in fact, you have to go and speak to a lot of experts to form your own views, but they really wanted to see that you had exercised your own judgment and it was you understood the diligence, and it was just a wonderful, deep experience in how to invest properly. And one of the things I took away from that experience is that I thought that the best private equity firms in the US have spent decades creating a really strong investment culture. And it's very difficult to teach investment culture. I think you need to grow. Well, it's certainly very helpful to grow up in it. And I know I myself felt like I learnt a lot about investing from my time there. Trent would say the same thing. So when we started Stonepeak, one thing we did is we really lent heavily on hiring folks from institutions that were very, very strong investment cultures. So we hired a lot of people from private equity. We hired a number of people from the credit hedge funds, just because we felt like learning about infrastructure assets, it takes some time, but it's very doable. We thought that it was more difficult to train investment culture. So we wanted to start the firm with folks who had and brought that strong investment culture that we'd so got to love at our Blackstone time.
How would you describe the investment culture at Stonepeak?
What we try and do is we try and take any ego out of the room, any hierarchy is taken out of the room. You just want a really data-driven, intellectually honest debate and discussion about the transaction. And there is a huge emphasis from me and from every senior person in the firm about how important it is to have a great investment culture at the firm, and how important it is to be intellectually honest about the deal that you're presenting, and any hint of salesmanship or, presenting your case too aggressively is really very heavily frowned upon. We go out of our way to not take criticism of a deal personally. I think that's really important. And I think a big element of that is making sure folks feel very comfortable and supported by each other, because it takes a lot to go and present something to the investment committee and to have people, throwing stones at your deal. And so it's really important that that's not taken in personally in any sort of way. It is like the foundation of the firm. The investment culture is the most important element of the firm, and we do everything we can to reinforce it, and we do everything we can to improve it over time.
In the early days, you had sub 10 people on the investment team. You're now, I think, over 290 people or so at the firm. You've scaled pretty quickly. It's been 14 years. How have you managed to preserve the culture you just talked about as you've scaled?
You've got to work really, really actively at it. I mean, I try to lead by example. I'm very involved in every final investment decision that we make. I'm on top of everything that we invest in a level of detail I think would probably surprise you. And that's partly because I want to be on top of it and I want to be involved in the decision. But it's also partly because I want to send a message to the firm of, look, if I'm doing it to this degree of detail, then, I expect at least as much from you as well. And on the other hand, it also rewards people who do a good job on their investment diligence and their investment process, because they feel recognition all the way to the top of the firm that I'm appreciating the good work they did. And if it's not so good, they also understand that there's consequences for that. And now, as the firm has grown and we've gotten more depth in leadership, there's a dozen folks at the top of the firm who, just as much as I do the same thing, go into the same level of detail and permeate that culture. So there's a lot of culture carriers at the firm. And look, I think culture is an ever evolving thing at an organization. And so what you hope happens, and I think happens here really well, is as new people join the firm, particularly if they've come from an organization that is special in itself, they'll bring new elements to the culture. So I don't see it as something that's fixed and I'm trying to just keep it as is. You want it to grow and evolve over time and sort of almost got its own character and personality to it. And hopefully it's improving, over the years. And I think that's happened at this place over time.
I think that's a great segue to the build out of Stonepeak Plus, the wealth business that you've created. I often think that building a wealth business it's an entrepreneurial endeavor within a larger platform, and it's building a business. The other aspect of it is that I think it's also really can emanate from it a lot of the culture and values and DNA that a firm has, and they're bringing that to bear in the wealth business as they're building this new business, working with new investors. How do you think that the wealth business that you're creating at Stonepeak is emblematic of the culture and values and DNA that you have as a firm?
The wealth channel is a incredibly important initiative for us. It is so critical that we get that right. Look, everything we do at the firm, it's really important we do it to the highest quality, really important. Like if we're going to do something, I want to be the best at it. So I'll only go into it if I think we've got the right people to lead it, if I think there's the right deal flow to feed it with really interesting investment opportunities. Because again, I want to be the best at every single thing that we do. And look, the wealth channel product is maybe the most public thing that we're doing. It will perhaps be the most reflective over time on the reputation of the firm. You only get one shot at it. You mess up something in our wealth channel product, that's the end of it. And so I feel like you're getting the very best of Stonepeak, completely focused on making sure that the wealth channel product, SP Plus, is a success.
What have you done to perhaps build the wealth channel business differently than others, or how have you approached the thought process behind that?
I don't look so much at what others are doing. I focus very much on how can we provide the best journey and the best product for our customers. That's literally all I'm focused on. And so really all we're trying to do is to make sure that the very best investments that come into the orbit of the firm, we try and make sure that the wealth channel product is getting exposure to all of those transactions. I just want a very high quality portfolio of assets that's nicely diversified, that I think we've gotten in at good and fair valuations, that will provide a good investment journey for our client base. It's literally all I'm focused on.
I think that's such a interesting way to put it. When I think of that, I actually think back to us talking a little bit earlier about cycling. You're a big cyclist, and you think about cycling, the outputs are the watts, but the inputs are the RPMs and the speed at which you're turning the pedals. How do you think about that aspect of your life, your passion for cycling, as it relates to how you think about your business? Because in some senses, yes, Tour de France is going on, you know, people can focus on others behind them in the race, but if they just focus on themselves, maybe that will save them time and in the long run be the right way for them to build their own business or be
I hope my investing is better than my cycling. I'm hanging on for dear life when I'm cycling. I have something of a vision for the firm and for the wealth channel product, but it's a bit amorphous, I would say. It's not a specific vision. I bring it back to just doing everything every day really well. And I think if you do that, and look, the big things are the investment decisions by far. They're the biggest events in the life of the firm. But to get there, you've got to do a lot of things before it well. You've got to execute origination very well. You've got to execute your documentation and your negotiation very well. So there's a lot of process and excellence that goes into that. But the actual investment decisions, the things you say yes to, the things you say no to, they're the big events of the firm. And my view is very much, if you get those right, the rest is going to take care of itself pretty much. You're playing with power if you're investing well, and you're playing very defensively if you're investing poorly. So, you know, to your point about just getting the process right and getting the mechanics right, if I had to boil it down, the most important thing is getting the investment decisions correct.
I think that's such a great way to encapsulate this conversation and wrap it up. As a cyclist, you just focus on your pedal stroke, and then the rest solves itself, right? That's kind of how you just described your investment process. Focus on the process, the answer comes out. I think that's such a great way to encapsulate how you just talked about the way you think and operate as a firm and how you think about the infrastructure space as a whole. So it's been a fantastic conversation.
Thanks, Michael. I
thanks,
really
Mike.
appreciate it. Thanks
Pleasure.
for having me.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going